Odds are increasing that the Federal Reserve is going to be cutting interest rates in September, and with that, so too are the warnings about the reaction of the bond vigilantes.
Don't f*** up in here.
Yeah, while President Trump continues to plead for more rate cuts and Secretary Bessent amps up the pressure, calling for 50 basis points worth of them in September, others, such as that Yardeni of Yardeni Research, are noting that the yield on the longer-term bonds, those yields that dictate borrowing costs such as mortgage rates, are moving upward. If inflation is going to be running higher amid tariff uncertainty and Federal Reserve rate cuts, which Tuesday's CPI report said could very much be the case, then those that lend the United States money, those bond traders, are going to demand a higher premium for doing so.
Now I gotta turn my back.
And JP Morgan echoed this point on Bloomberg on Wednesday.
So the long end doesn't really care how much the Fed cuts at the front end, and so that's not really going to do anything for mortgage borrowers or small business borrowers.
So make no mistake, while these rate cuts coming from the Federal Reserve will no doubt help the United States to fund its short-term borrowing costs, it might not help with those interest rates, those mortgage rates available to consumers. As we've seen since fall of 2024, it could in fact make it worse.